Today, Tuesday, July 14th, 2026. It's just a day of, well, impossible contradictions for you.
Oh, absolutely impossible.
Right. I mean, gas prices are plummeting while the global oil supply line is literally under fire. Tech stocks are booming across the board, but then one of the world's biggest legacy tech giants just crashed, what, 22%?
Yeah, 22%, just a massive hardware shortage.
Right. And then on top of that, you have this historic, suffocating heat wave keeping 60 million people trapped indoors, which has inadvertently triggered the biggest economic entertainment boom in American history.
So a lot to take in.
It really feels like you are living in a split-screen reality right now. On one side, global friction and these physical extremes are pushing the world to the breaking point. And on the other side, domestic markets and cultural events are just shattering records.
It is a dizzying landscape to navigate. I mean, you look at the raw data coming across the wires today, and your initial instinct is to kind of treat these events in isolation, you know?
Sure.
A military strike here, a corporate earnings report over there. But beneath the surface, the structural dependencies between these seemingly random events are incredibly tight.
Which is exactly why we are here.
Yeah.
Our mission for this deep dive is to map out those dependencies for you. We are taking a massive stack of today's news sources and really connecting the dots.
And it's a wild set of dots today.
Oh, it really is. We are linking a military choke point in the Middle East, a bizarre paradox hiding right in your inflation data, a dangerous heat dome creeping across the country, and a soccer match that just brought the entire nation to a standstill.
It sounds chaotic, but it all links up.
It does. And to understand how it all links up,
Yeah.
we have to start with the most volatile piece of the puzzle on the geopolitical side of the screen.
Yeah.
And that is the Strait of Hormuz.
Yeah, the situation surrounding the strait is evolving by the hour right now. It's moving far beyond standard diplomatic friction into direct kinetic action. Just look at the whiplash on maritime policy.
A cargo toll, right?
Exactly. The U.S. administration abruptly reversed the 20% Hormuz cargo toll that they literally just announced.
Wow, already.
Yeah. Instead of a direct transit tariff, the administration replaced it with newly promised capital investments from Gulf states directly into U.S. infrastructure. So it is a pivot from penalizing maritime traffic to extracting sovereign wealth commitments.
Okay, let's unpack this, because declaring a highly contested 21-mile-wide waterway simply open after bombing coastal infrastructure, that is a massive logistical gamble.
Well, it absolutely is. Because that financial pivot happened alongside a massive escalation in force. The physical U.S. blockade of Iranian ports went into effect exactly as planned, and CENTCOM initiated preemptive strikes.
Right, they hit some major targets.
They did. They hit a critical power plant on Iran's Kish Island, with subsequent explosions confirmed in Bandar Abbas and near Sirik. And immediately after neutralizing those targets, CENTCOM declared the waterway open to all global shipping.
Well, open with a strict ban on any Iranian vessels, right?
Right, exactly.
But you can't just mandate safe passage through an active war zone and expect the global shipping industry to blindly sail through. I mean, Iran's immediate response proved that deterrence hasn't been established at all.
Far from it. The Islamic Revolutionary Guard Corps struck back almost instantly. They targeted and disabled 2 United Arab Emirates oil tankers that were transiting the southern Hormuz lane.
And crucially, that was within Omani territorial waters.
Yes, which makes it even more complicated. The human cost is already mounting too. 1 crew member killed, 8 wounded, all of that confirmed by the UK Maritime Trade Operations Center.
Man, that is just tragic. And the diplomatic rhetoric matching this violence, it leaves zero room for misinterpretation.
No room at all.
Israeli Prime Minister Benjamin Netanyahu issued a very severe public warning directed at Iran, stating, "Don't count on silence." He explicitly vowed a far more powerful broadcast.
Which is a clear signal that Israeli military assets are prepared for severe, disproportionate retaliation if these attacks on U.S. and allied assets continue.
We have to look at what this fear is doing to the actual physical movement of goods, though. Because the tracking data from Krapler's tells the real story here, and the numbers are terrifying.
They really are.
Before this war broke out in late February, an average of 147 commercial vessels crossed the Strait of Hormuz every single day. On July 9th, that number plummeted to just 22 ships.
Just 22.
Think about a major global 8-lane highway being abruptly reduced to a single, unpaved, highly dangerous dirt path. With traffic down from 147 massive cargo ships to just 22, how has the global supply chain not completely fractured?
Well, it is experiencing structural microfractures as we speak. Global markets are currently absorbing the shock by burning through strategic reserves and paying just astronomical insurance premiums for any vessels willing to actually brave the route.
And diplomacy isn't exactly saving the day.
No, diplomatic triage is completely failing to secure a safety net. Iran's foreign minister Arachi claims mediation is ongoing with Oman, Qatar, and Pakistan. But the International Crisis Group just released a devastating assessment.
What do they say?
They declared the June 17th de-escalation memorandum of understanding to be in tatters. The terms were inherently ambiguous to begin with, and now both factions are simply using ballistic missiles to enforce their own preferred interpretations of international maritime law.
Wow. And that international instability is triggering a severe constitutional shockwaves back in Washington, too. Senate Democrats just blocked the National Defense Authorization Act in a 50-46 vote.
A very tight vote.
Right. And let's dig into the mechanics of that, because the NDEA is traditionally the most routine, must-pass piece of legislation in government. It simply funds the military. Halting it over objections to the Iran war is a monumental disruption of standard operating procedure.
Mechanically speaking, it represents one of the most significant Senate votes against executive wartime authority in modern history. The Senate is utilizing the power of the purse, literally freezing the budgetary pipeline, to force a debate on the scope of military engagement.
Just putting the brakes on everything.
Exactly. By stalling the NDAA, they are asserting a massive procedural roadblock. They are demanding that the legislative branch formally authorize or rein in the cascading strikes occurring across the Middle East. It is a textbook constitutional friction point playing out in real time.
Which brings us perfectly to the economic side of our split screen. You have military blockades and legislative gridlock, yet the domestic financial data dropping today feels like it belongs to a completely different planet.
It really does. I mean, the June Consumer Price Index came in unexpectedly cool at 3.5%, actually beating the 3.8% forecast.
And the primary catalyst for that cooling was a massive 10% drop in gasoline prices at the pump. But this is a glaring paradox. Gasoline dropped 10%, but Brent crude oil, the foundational commodity gasoline is refined from, is holding stubbornly above $80 a barrel.
Right, precisely because of those tanker strikes in Hormuz we just talked about.
Exactly.
You're looking at a masterclass in supply chain bottleneck economics here. How does the raw material stay expensive while the finished product gets cheaper? The answer dictates why the refining sector is currently just minting money.
Record highs, right?
Unprecedented all-time highs. Valero is up 80% in 2026. Marathon Petroleum is up 86%. PBF Energy has skyrocketed 123%. They are exploiting the mechanics of widening crack spreads.
Okay, let's translate crack spread into something tangible for you. Let's say you own an industrial bakery. The global supply of raw flour, which is your crude oil in this scenario, is incredibly expensive because cargo ships keep getting attacked.
Right, the raw material is pricey.
Exactly. But you control the massive, highly specialized ovens required to turn that flour into bread. Consumers are buying slightly less bread, pushing the retail price of a loaf down 10%. But because you own the bottleneck, you can squeeze the margins in the middle.
You control the process.
You buy the expensive flour, process it, and dictate the wholesale price to the grocery stores because they literally cannot bake it themselves. You reap record windfall profits, insulated from both the high cost of raw materials and the dipping retail price, purely because your infrastructure is irreplaceable.
The infrastructure is the leverage. Refiners own the bottleneck, giving them total pricing power over the crack spread, which is that margin between the cost of crude and the selling price of refined products.
It's incredible.
And this theme of record-breaking financial leverage isn't isolated to energy. The broader financial sector is demonstrating surreal resilience today. Goldman Sachs just surged 7.6% on a blowout second quarter.
7.6% is huge for Goldman.
It is. And JP Morgan reported managed revenue of $58 billion with earnings per share at $6.14. That was driven by a staggering 86% surge in their equity markets division. Institutional money is relentlessly pouring into the market, entirely dismissing the geopolitical risk.
They are completely ignoring the Federal Reserve, too. Fed Chair Kevin Warsh delivered his Humphrey Hawkins testimony today, revealing that the median year-end rate projection has moved up to 3.8%.
Which is a hawkish signal.
The very hawkish signal. Something like that usually triggers a market sell-off, but Wall Street barely blinked. However, there was one spectacular casualty in the markets today, and it tells us everything about where capital is actually flowing.
Yeah.
IBM's stock just cratered by 22% in a single trading session. 22%.
If we connect this to the bigger picture, IBM's collapse perfectly illustrates the brutal reality of the artificial intelligence infrastructure rush. IBM CEO Arvind Krishna was forced to admit that clients are aggressively canceling or delaying large-scale software and consulting contracts.
Because they need hardware instead.
Exactly. Why? Because you cannot run next-generation AI models on legacy enterprise software. Companies are abruptly realizing that AI requires massive physical computational power.
They are taking all of their capital expenditure and throwing it entirely into physical servers, raw compute, and specialized memory hardware. Software is taking a backseat to steel and silicon.
And the market data proves that hardware pivot beyond a shadow of a doubt. While IBM's software-heavy business crashed, the VanEck Semiconductor ETF climbed 2.5%.
Even with SK Hynix falling.
Yeah, SK Hynix did fall 8% on the Seoul Exchange, but that was strictly post-IPO profit-taking after a historic $26.5 billion NASDAQ debut. The underlying institutional demand for the physical chips that power AI data centers is absolutely insatiable.
Insatiable. And those AI data centers require an incomprehensible amount of electricity and cooling capacity, pushing regional power grids to their maximum threshold.
Which brings us to the environmental crisis.
Right. That insatiable digital demand for energy is colliding directly with a physical environmental crisis. The same power grids straining to keep server farms online are now facing a historic, lethal heat dome.
It's a perfect storm.
Here's where it gets really interesting. Because we aren't just talking about a hot summer afternoon, we are tracking a meteorological anomaly that shattered all-time temperature records across Montana, Utah, and the Dakotas, and is now aggressively marching eastward.
It's moving fast, too.
It is baking the Midwest right now, triggering National Weather Service advisories across Chicago, Minneapolis, Cleveland, and Pittsburgh. By Wednesday, it hits the I-95 corridor. New York, Philly, D.C., and Boston are all bracing for upper 90s. Over 60 million people are currently under extreme heat warnings.
And health officials are zeroing in on one specific meteorological metric that elevates us from a severe weather event to a public health emergency. It is the failure of the overnight lows.
The nights aren't cooling down.
Exactly. The forecast models show nighttime temperatures refusing to drop below 75 to 80 degrees across these densely populated urban centers.
We've talked about the biology of that, because the human body is essentially an organic engine. Surviving an extreme heat wave is like running a marathon, but when you cross the finish line, you are legally forbidden from sitting down to rest.
That sounds exhausting.
It is biologically exhausting. Your body relies on vasodilation and the hypothalamus to sweat and dump internal heat. But that biological cooling mechanism requires the ambient air to be cooler and drier than your skin. When the overnight lows stay pinned at 80 degrees, the heat transfer just stops.
The engine can't cool down.
Right. Your internal organs never get the physiological reset they desperately need. The cumulative thermal load just builds and builds until the system collapses.
And that cumulative thermal load is what drives exponential spikes in emergency room visits. The physical constraints of this weather are dictating human behavior on a massive scale right now.
60 million people essentially mandated to stay inside.
60 million people sheltering indoors with their air conditioning cranked, simultaneously seeking an escape from both the inescapable physical heat and the relentless geopolitical anxiety dominating the news cycle.
So you trap tens of millions of stressed people in their living rooms. And what happens? They seek out a collective cultural escape, they turn on their televisions, and that physical confinement has artificially engineered the environment for the biggest shared entertainment event in the history of the United States.
The World Cup semifinal between Spain and France at AT&T Stadium.
What a match.
Oh, Spain secured a masterclass 2-0 victory. Mikel Oyarzabal buried a penalty. Pedro Porro executed a flawless give-and-go finish, and the Spanish defense completely neutralized Kylian Mbappe. It was elite tactical soccer, but the metrics generated outside the stadium are what truly matter.
The viewership numbers are difficult to even comprehend. Fox and Telemundo recorded 43 million U.S. viewers for that single match.
43 million.
43 million. The previous all-time record for a soccer broadcast in this country was 30 million, set during the Belgium-U.S. match years ago. They didn't just break the record, they obliterated it.
They smashed it.
And the economic shockwave hitting the local infrastructure is just as massive. Officials in the Dallas-Fort Worth region estimate this single match generated $500 million in direct economic activity.
What's fascinating here is how live sports remain the ultimate, undeniable economic catalyst. We live in an era of hyper-fragmented media. We stream different shows, we listen to different audio, we live in different algorithmic bubbles.
A reality we will definitely see highlighted when Netflix drops their Q2 earnings this Thursday.
Right, exactly. But a live sporting event cuts through that fragmentation instantly. It aggregates human attention at a scale that allows for $500 million to be injected into a single metropolitan area in just 48 hours.
And the momentum is still accelerating. Tonight, at Mercedes-Benz Stadium in Atlanta, England, led by Jude Bellingham, faces off against Argentina and a surging Lionel Messi, who already has 8 goals in this tournament.
It's going to be massive.
The winner advances to play Spain in the final this Sunday at MetLife Stadium in New Jersey. Fox and Telemundo are openly projecting that Sunday's broadcast could shatter the 50 million viewer threshold.
50 million for soccer in the U.S.
Right. So what does this all mean? When you have 43 million Americans watching a semifinal and projecting over 50 million for a final, is this simply a novelty born out of the fact that the U.S. is physically hosting the tournament? Or are we witnessing a permanent fundamental shift in the American cultural bedrock, where soccer finally elevates to sit equally alongside the NFL?
Well, the capital allocation suggests a permanent shift. Corporate America is watching these viewership numbers and that $500 million local impact. The infrastructure for soccer has been slowly building for decades, but it required this exact flashpoint.
The perfect storm.
Yes, a globally dominant tournament combined with a paralyzing heat wave that forced a captive audience indoors. That cemented its primacy. Advertisers and broadcasters will underwrite the sport fundamentally differently starting Monday morning.
It is a profound realignment, and it perfectly encapsulates the extreme contrast defining July 14th, 2026. You are navigating a reality where the Strait of Hormuz is squeezed down to 22 ships while the U.S. Senate deliberately blocks military funding.
Yeah.
You are watching a paradoxical economy where gas is cheap, crude is expensive, and refiners are quietly pocketing billions. And you have 60 million people sheltering from a biologically dangerous heat dome, driving them indoors to forge the most lucrative, widely watched soccer event in national history.
It demands a complete recalibration of how you interpret the news. The geopolitical violence and the extreme environmental data reflect a very harsh physical reality. Yet, looking at the bank earnings, the semiconductor surge, and the World Cup consumption, the domestic consumer and the financial markets are operating with almost delusional optimism.
As we wrap up this deep dive, I want to leave you with one final thought, a thread that ties the geopolitical violence directly to that crashing legacy tech stock.
Let's hear it.
Look at the 2 most disruptive events we analyzed today. First, a U.S. military strike deliberately targeting a physical power plant on Iran's Kish Island to blind their operational capabilities. Second, IBM, an enterprise software titan, watching its valuation plummet 22% because the market abruptly realized that the most advanced AI software is totally worthless if you don't possess the physical memory chips and server racks to run it.
The vulnerability in both scenarios is entirely physical.
Exactly. For 20 years, the prevailing wisdom has been that software eats the world. We obsessed over the cloud, algorithms, and digital abstraction. But look at what is actually dictating the terms of reality today.
It's all physical.
It is physical cargo ships navigating a physical strait. It is physical oil refineries choking supply. It is physical ambient heat overwhelming human biology. It is physical server racks drawing physical megawatts from the grid. In our hyper-digital 2026 world, you have to ask yourself, is physical infrastructure, the actual undersea cables, the raw steel, the semiconductor foundries, and the power grids, suddenly becoming infinitely more valuable and dangerously more vulnerable than any piece of software running on top of it?
It is the ultimate boundary of the digital age. You can virtualize currency, you can automate intelligence, but you cannot digitize your way out of requiring physical power, physical shelter, and physical supply lines.
The next time you look at the news and see that split-screen reality, pay close attention to which side relies on software and which side relies on hardware, because right now the hardware is dictating the terms of survival. Thank you for joining us for this deep dive. We will be right back here next time, ready to decode whatever the world throws at us.